Last week, we covered the introduction to credit risk. We saw what it was. We saw how we could do calculations about the probability of default. We saw how we can calculate the value of a bond, and we saw the Markov processes, and so on and so forth. We saw the mathematical foundations for that. Today, I'm going to see how these things become commercial products, how a credit risk is done in practice. And we're going to go through a number of considerations, but also at the same time a number of examples, which I will do today. I want to start reminding you of an equation that we derived last week. This is the equation for sovereign risk. In this equation, what we have is we have the probability of solvency, which we called Q, the probability of default that we called 1 over Q, and there were two basic blocks for the two events that might happen, which is default or no default. In the case of a default, we will get a recovery rate, and in the case of no default, we get the full amount. But that will only happen with a certain probability, Q, which is the probability of solvency. In that, we also included the notional of the bond. This was a sovereign bond, and the notional today is going to be replaced by another term, which I'm about to define, and that's the term which is called credit exposure. In the case of the bond, this is a number that we know. It's a fixed amount. However, in practical situations, this is a number that will change, as we are about to see. And the third element is the recovery rate. Now, let's reflect on these three. These are the three main variables. Everything else there we already know. We know interest rates, and if with that information, we would be able to value the bond. So we have the credit exposure, which is the notional of the loan, denoted by N. We have the probability of default, which is 1 minus Q, or equivalently, the probability of solvency. And this is a number which is also stochastic. And then we have the recovery rate, which is how much we get if the counterparty does not pay. Sometimes we get nothing, sometimes we get something. And it's also something that we don't know. This is a very good expression that tells us the difficulties of doing credit risk. We are dealing with three simultaneous processes, three unknown variables that move in sometimes related ways, sometimes unrelated ways. And where I want to start with today is by paying attention to each of those three so we understand what they mean. The first one that I want to address is credit exposure. Credit exposure in a credit situation is the maximum loss that a portfolio can experience. We do that by selecting a particular the whole duration of the instrument. So at any time in the future, what's the largest amount we could lose? In some situations, this number is going to be infinity. So because of that, we take this number with a certain level of confidence. To show you what this might look like, I have here the example of what the credit exposure would look like for the Goodrich swap. Okay, so the Goodrich swap, which we saw last week, is a $50 million swap that has payments every 6 months. So at the beginning, I'm going to write it down here. At the beginning of the swap has a credit exposure of, so it has a value of 0. I didn't get to the credit exposure yet. The value of the swap is 0 when we start. But as time goes by, as time flows, interest rates could go in our favor or against us. We don't know. So we take the worst case scenario, which is how much money the swap would go in our favor because that's how we can lose. Remember that, right? So this growth represents the uncertainty in interest rates as we go over time. Every 6 months, we're going to get a payment. So every 6 months, the exposure is going to drop because once we get the payment, the value of the swap is going to go down. So what we have here is a graph which is the value of the swap. Okay. Now, when we do the value of the swap, as I said, we start at 0. Every 6 months, we get a decrease. So there you go. So the credit exposure will be defined as the quantile of our losses. So if I pick the 99% credit exposure, what I do is at every point in time, I select the loss we can have within a 99% confidence interval. This is the curve that I have in green. I could look at the 95% confidence interval. That will give us the curve in blue. And now the credit exposure will be the largest amount that we see in that future value curve. Okay, so again, the way we do it is we look at the evolution of the possible values of our portfolio over time with a certain confidence interval, 99 or 95, as we have in this example, and then we look at the maximum possible value. So in the case that we have here, we see that the credit exposure is 70 million. The swap could move against us by a large amount, could be bigger than the notional. And in the case of 95%, it's about 42 million or something like that. Okay, so that's what the credit exposure is the largest amount of money we can lose. Okay, we set that aside. That's the first risk factor. The second is the recovery rate. As I mentioned last week, in the case of default, the value of the portfolio is not completely lost. Sometimes we can recover some of that. So the recovery rate will represent the percentage value which we expect to recover given default. Loss given default is the opposite. Loss given default is the percentage that we expect to lose in the case of default. They are the opposite of each other. So recovery is 1 minus loss given default, and loss given default is 1 minus recovery. And the modeling of this is very involved. They can be modeled as random variables. Today, we're going to model this as one of two things. We're going to either take them to be constant, just like we did last week, or towards the end of class today, I will introduce the Merton model and the KVM and the KMV model, where the recovery rate will be given to us by a precise stochastic model that we'll derive. Okay, so we're going to be looking at that in two ways: either constant or as a built-in stochastic term. I have here two studies, one done by Lieberman, one done by Altman, in which what they did is they went through bond defaults through history, and they looked at the recovery rate that they found in those. So this is what's called a heuristic. This is an empirical study. Okay, study. And in the empirical study, they looked at 5 type of bond tranches. Where are they? So what these are as follows. The junior subordinated is the one which is first to lose, and the senior secure is the one which is last to lose. So remember how bankruptcy happens, so how default happens. When a company has to pay and they cannot pay, what they do is not all obligations are the same. Some obligations have priority over others. And the way that works is as follows. When a company defaults, the first thing they have to pay is taxes. Taxes is always the first thing that they need to pay. And the government is always the first one to collect. The second one is the expenses, the liquidation expenses. They have to pay the liquidators. They could be audit companies. They could be whatever it is. That comes second. That comes before the bondholders. The bondholders will be paid after that. But then not all bondholders are the same. Some bondholders get paid first. Those are the senior secured. If there's money left over, then the senior unsecured will be paid next, then the senior subordinated, then the subordinated, and then the junior subordinated. I'm assuming here 5 layers. In practice, it's more like 2 or 3, but in this study, they were a bit more granular and they picked 5. And what they found is that these are the number of cases that they had. What they found is that, as you can see here, the average for senior secure is about 50%, whereas the average for the subordinated is about 32, is about 30%. So that's the range of what we expect to recover. I mentioned last week that we picked 50 as a number we're comfortable with. It's very easy to work with, and you can see that it's actually a pretty realistic from the historical, from the empirical perspective. Now, there's a question in the chat. Okay, so no, each layer gets the full amount they are owed until the money runs out. On occasions, you can have negotiations. That's very typical in the case of country risk, sovereign risk that we discussed last week. A country may go and settle their obligations in special ways to all of their debt holders. But typically, in the case of corporate debt, is the first bonds get paid in full. Then you go to the second, then the third. And if there's money left over, you go to the ones after that. Okay. All right. So we're going to describe the default process as a stochastic process, which is a time-dependent process. It's not an Ito process. It's a very, very simple stochastic process, which is equal to 0 when we're solvent and is 1 when we're at default. And from that perspective, we now notice that the probability of default that we worked with last week is nothing but the expectation of my stochastic default process. So in other words, we now get into the actual nature of what gives rise to the probability of default. Okay, it's the expectation of this default process. All right. So with these 3 definitions we have introduced the credit loss of a portfolio with a single counterparty. A single counterparty is defined as the product of my default process, my credit exposure, and my loss given default. Okay. Now, it's important here to observe that these 3 stochastic terms depend on different risk factors. The first one depends exclusively on the quality of the counterparty. So if my counterparty has good credit, this credit risk process is going to stay very low. If it has bad credit, it's going to stay very high on probability. The second one depends on the portfolio. If I have a certain portfolio with a counterparty called Apple, and I have a certain portfolio with a counterparty called Joe's Corner Store, the credit exposure is exactly the same. The default process will be different, but the credit exposure is the same. It's only dependent on the portfolio. And the third one is somehow a legal term or a legal the stochastic nature of it is a function of where within the capital structure of my counterparty I am. So this is something that has to be evaluated, taking into account corporate finance considerations. Okay. Now, when I have more than one counterparty, the solution or the expression is the same. I just add the same term over all of my counterparties. So at least the mathematical expression for that is very simple. It's just the sum of the individual credit losses for each of my counterparties added together. Okay, the same as we had now, but now we do counterparty to counterparty and we add it up. The result of that is going to be a stochastic process, very complicated stochastic process that at any point in time is going to be a credit loss distribution. It could be very difficult, it could be very hard to understand, but it is a distribution at the end of the day. We can now think of this from a very simple statistical perspective, taking into account its expected value, which is what we will call the expected loss, and the standard deviation, what we will call today the unexpected loss. Okay, what does that mean? If I have a very complicated portfolio distribution if I have a very complicated probability distribution, you know how you deal with that in statistics. The first things that you measure are the mean and the standard deviation, always, whether they're Gaussian or not. You always look at the mean and the standard deviation. We're doing the same. In this case, the mean has a financial meaning, which is the expected loss, and the standard deviation has also a financial meaning. We're going to call it the unexpected loss. And throughout the next hour, we will see how relevant the standard deviation or its cousins are going to be for us. So my distribution could look like something like that. Again, I pick a point in time in the future, and then I look at my credit loss distribution function. It looks something like this. I don't have credit gains, I only have credit losses. So it's asymmetric to begin with. It's a distribution that has very fat tails. It takes a long time to die, as you can see in the picture. And then there's two statistical properties of it. One is the expected loss, which is the expectation of this distribution, and the other is the standard deviation, how spread out this distribution is. As you can see, it's very far from Gaussian, and of course, being asymmetric, it better be. Okay, but for now, let me just leave those two elements there, and I will tell you what these elements mean from a financial perspective. To do that, I'm going to define now another term which is going to be useful for us in explaining credit, and that's the credit value at risk and the worst credit loss. I know we went through value at risk 2 weeks ago. The credit value at risk is going to be different, slightly different. The value at risk that we saw, I remind you, was for market risk. Now we're dealing with the credit value at risk, which is for credit risk, and it's defined as follows. First, I define the worst credit loss. The worst credit loss represents the credit loss which will not be exceeded with some level of confidence over a certain time horizon. It's exactly the same mathematical definition that we did for value at risk 2 weeks ago. 2 weeks ago, value at risk was the quantile of a market loss distribution, the P&L. Today, worst credit loss is the same quantile of the credit loss distribution function. Okay, so you should see that parallelism there. The value at risk of 2 weeks ago and the worst credit loss of today are related. They are the same mathematical object. What is different is the underlying probability distribution. Okay, and it's important to note that the value at risk that we saw 2 weeks ago and the credit value at risk we see today are not the same. They differ by a very important element, which I'll tell you now. Okay, so now first let me define the credit value at risk. The credit value at risk represents the credit loss which will not be exceeded in excess of a certain of the expected credit loss with some level of confidence over a certain time horizon. Now, what does that mean? What that means is that the credit VaR is the worst credit loss minus the expected loss. Okay? It's the standard deviation minus the expected loss. I'm going to show you several examples in which you will see why this is relevant. This is not math, this is finance. We're going to need finance to understand why we do things like that. Okay? Now, let me first show you this by going back to our previous picture and show you here that, I remind you, I had the expected loss and the unexpected loss, which was the standard deviation. So in this one, if my worst credit loss is that point that I have there on the x-axis, okay, it's a quantile, so it's going to be on the x-axis, then my credit VaR is going to be the distance between the worst credit loss and the expected loss. Why are we doing it like that? Here's the reason. We're going to see this in an example, but let me tell you now the theoretical reason. The theoretical reason is if I have a credit transaction, the amount of money I can lose for risk accounting purposes is going to be broken into two parts. The first is what I expect to lose. It's called the expected loss. And the second is what could happen in excess of the expected loss, and that's the credit VaR. The sum of the two is the worst credit loss. So what I'm doing is I am dissecting the worst credit loss into two parts, the expected and the unexpected, represented in this case by the credit VaR. Okay, we will see an example. We'll see several examples in which that will be I hope clear. So let me give you here my first example. I have a 95% worst credit loss of a $5 million on a certain portfolio. What that means is that the probability that I lose more than $5 million is only 5%. That's exactly the meaning of that. That's the worst credit loss. If I have a daily credit VaR of $5 million in a certain portfolio, that means that the probability that I lose more than $5 million in excess of my expected losses, whatever they are, is 5%. Okay, this has to do with the concept of regulatory capital and credit reserves. So let me explain what that is. This is how banks work. This is something that we touched upon 2 weeks ago when we talked about risk management, and now it's going to become very important for us because it will determine the price of credit transactions. So inside say a bank, I'm going to use a bank because a bank is a very nice regulated entity we understand very well. So in a bank, the risk accounting is done by taking into account losses that come from two pools of events. The first is what I call the credit reserves. This is what we reserve to absorb expected losses. Okay, so if I have, let me use the example of an insurance company. If I sell you car insurance and you pay me $1,000, and of that, I know that I'm going to have to pay approximately 10%. That's going to be your claim. So of the $1,000 you give me, I know $100 of that is going to be for the credit reserves because that's what I expect to lose on your car policy. That's what's called the credit reserves. They are reserves which are there because I know, I'm pretty sure I'm going to be losing that money. However, for regulatory reasons, I need to have other types of reserves, which is called regulatory capital, and that's what I will leave with, typically with the central bank or with my regulator. This is the capital which is designed to absorb unexpected losses. You could have a very big accident, and then the losses will far exceed the expected loss. Could even far exceed the total premium that you pay. That is accounted for differently. That is accounted for as regulatory capital, and that is money which is sent to the regulator. The first one is kept by the bank to take care of expected losses. The second is typically sent by the regulator. The regulator will take that and remove it from my ability to do business, which is in the intention of that being that I don't do business using capital that I may need in the case I have a certain event. So from this perspective, the worst credit loss measures both. It measures what I can lose from the expected as well as from the unexpected. So the worst credit loss measures the internal credit reserve and the external credit reserve. The external credit reserve is what I send to the regulator, and this is what we call credit value at risk, and that's why credit value at risk is defined like that. Do you understand that? This is a very important point to understand. Credit value at risk is a quantile minus the expectation, because the expected losses I keep internally because those losses are coming. But the difference between that and the maximum loss I can have, that is part of the calculation of the regulatory capital that I will be sending to my regulator. Okay? We're going to see an example of that. In the case of credit reserves, losses come from defaults. However, in the case of regulatory capital, I can have losses from a credit migrations. For example, if my counterparty gets downgraded but did not default, the expected loss maybe goes up or down. I haven't lost any money on that, but my regulatory capital may go up. In other words, no default has happened. Still, I have an increase in my regulatory capital. Okay, we will see this one example coming up that I think will make it very, very clear. All right, so that is why we define a credit VAR and worst credit loss like that. Okay, now expected credit loss is the expectation of my credit loss. The credit loss is a very complicated random process. I take its value, I take its expected value at a particular point in time. That will be the expected credit loss. If the factors were independent, the expected credit loss will then be the product of each of them, the product of the expectation of my default indicator, the product of my expected credit exposure, and the product of my expected loss given default. The first term is what we call probability of default. The second term is the expected exposure, and the third is the expected recovery. And what I want you to notice here is that this is exactly the formula that we used last week when we were doing the sovereign default calculation. Okay, so in other words, in this first half hour, what I have done is I gave you these building blocks, and we've managed to recover the same equation I started with today. That's what we have achieved. But in doing that, I've told you the components of credit risk. I've told you the difference between the internal economic capital and the external regulatory capital, and the elements that give rise to that. Okay? All right. So having done that, what I want to do now is I want to do two examples which are, I think they are simple, but I hope they give you some light as to how these things work in practice. Okay? The first is going to be the example of a commercial mortgage. Now, let me tell you what a commercial mortgage is. I think you all know what a mortgage is. An individual, a couple, they buy a house, and when they buy the house, they take a loan. The house is the collateral for the loan. You pay a certain interest rate, and that's how it works. Now, companies can do the same. Typically not for a house, typically for a larger building, could be a building tower, could be a shopping mall, for example. Okay. When that happens, there's a very interesting feature to commercial mortgages, which is they're very different from residential mortgages. They have an increased credit risk profile. Commercial mortgages are riskier than residential mortgages. And now we're going to understand why. With everything we've developed, we will understand why commercial mortgages are going to be riskier. I'm going to do it with very simple numbers. It's an example with numbers. The numbers are picked simple, so the mathematics is easy. So don't think that the implications of this in practice are going to be, they're not meant to be exact. This example is meant to be a metaphor, not an example. Okay, all right. So to do that, consider a commercial mortgage with a shopping mall as a collateral. When you have that, I'm going to give some numbers to this deal. I want to assume that the exposure of the mortgage is constant, $100 million. It's constant. It's not going to change. I'm going to assume a expected probability of default of 20%, but it could vary. I want to allow a 10% standard deviation variation for my probability of default. So I'm going to say that the probability of default could be 30% or 10% with 50% probability. Okay, it can fluctuate between 30 and 10. That's why I say has a probability of default of 20% with a standard deviation of 10. And then finally, I include an expected recovery of a 50% with a standard deviation of 10. In other words, I introduce an expected recovery that could be 60% or 40% with 50% chance. We're not sure, one or the other. Okay, that's the modeling. These are the numbers that I'm giving you. And now the problem I would like to do is I would like to calculate the expected loss in two ways. The first one is the simple one. I want to assume independence between the recovery and the default of my commercial mortgage. I call it X. We're going to calculate that. It's very easy. The second is I'm going to assume a negative correlation. I'm going to say minus 50, but a negative correlation between the default probability and the recovery rate. I call it Y. Now, this is the important part. Let me make sure that you understand the finance of this. The finance of this is the following. Negative correlation, what does that mean? That means that when the probability of default is higher, the recovery rate is lower. And that is what happens with commercial properties. Typically, say a shopping mall. If a shopping mall defaults, shopping malls are owned by large corporations. That means that the large corporation will default on the loan for the shopping mall. If they are financially weak, that weakness doesn't happen immediately. It typically happens over time. Because of that, what they do is they lower the maintenance standards of the collateral. Okay, imagine that you are a property manager. You own certain you own certain shopping malls, but your financial situation is weak. You have to cut costs. What costs do you cut? Well, you typically cut the costs that keep your property healthy. You may, for example, not clean the concrete, so the salt may get into the structure and may start to crumble. You may not do proper plumbing. You may not take care of the electrical system. So the property, which is the collateral for the bond, typically deteriorates as your financial position deteriorates. And that's what I'm trying to capture, expressing a negative correlation between the probability of default and the recovery rate. Do you understand that? This is a financial concept expressed in very simple mathematics. Okay, I hope it's clear. Okay, I hope it's clear. So I'm going to ask you now for the numbers X and Y. Now, instead of just giving you the answer, what I like to do is I like to give you 4 options, and then let's just go through the options and let's see which ones let's see what we think about that. The first one is this. I'm going to give you an option, which is that A is equal to $10 million and Y is equal to $10 million. I think we can rule this out. We can rule this out because, why? We just argued that Y should be bigger than X. So that should not be the one. How about this one? X is 10, Y is 20. Could be. That could be. It's consistent with our financial interpretation. How about this one? X is 10, Y is 5. I don't think so. That should not be, because we just argued that Y should be bigger than X, not smaller than X. And then I have another one in which Y is just a little bit bigger than X. So again, to recap, what we have here is we know that X should be lower than Y from financial reasons. So I'm trying to develop your financial intuition on credit. So we expect X to be lower than Y. So we rule out those two. So the answer is going to be between B or C. And for that, we're just going to do a calculation. Okay. Now, in my calculation, I'm going to have to do, well, there's two approaches to do my calculation. The first approach is completely analytic, which I don't find it very interesting, but I will still show you. I just multiply the random variables. I use the calculation I use the correlation to calculate the expectation of the product. Okay, I can do that because they will be, say, you can model that with, as you know, the expectation of the product is something you can do as long as you know the correlation, and we know the correlation. So it can be done analytically with the math you've learned before coming to this course, but I'm not going to do it analytically. I'm going to follow the simulation approach because it's more intuitive, and I hope we learn something from it. For that, what I'm going to do is I'm going to simulate a process that matches the same characteristics that were given to us. I'm going to create two equally likely future credit states of probability, of default probabilities 30% and 10%. So that is in agreement with the data that I presented to you, and two equally likely future recovery states given by 60 and 40% each. So this will be consistent with that. Now, in order to do that, we need to understand how you can think of each of them as a coin flip, 30 and 10, 60 and 40. But remember, I told you the correlation is going to be negative. So how can you deal with two events like that, 30-10, 60-40, when the correlation is not zero? You need to learn how to do correlated coins. And this is something which I want to, now I'm going to give you a 2-minute crash course on probability. You're supposed to know this, but I don't know. I'll just explain to you. So in this case, my credit event, my simulation approach later on today will turn into a very big Monte Carlo exercise. Okay, so let's start with a simple one that we understand, and then we will do the Monte Carlo one later today, about an hour or so. Okay. So what we're dealing with here is we're flipping two correlated coins. I would like to ask if you know how to do that. Because I'm online, it's hard for me to read your body language or even read your answers. So I'm going to do it for you. I'm going to, what I need to do to calculate my Bernoulli process of two correlated coins, I need to calculate four numbers. The probability that both my events go up, the probability that one goes up, one goes down, the probability that the first goes down, the second goes up, and the probability that both go down. I call them P++, P plus-minus, P minus plus, and P minus minus. Okay? If I have these, then I have everything, because two correlated coins only have four outcomes, which are given by these numbers. By the way, if they were uncorrelated, we know what the answer is, right? The answer is 25%, 25%, 25%, and 25%. But if they are correlated, positively or negatively, those numbers will change. And that's what I'm going to calculate for you now, very, very easily, very, very simple. Because for that, what I do is I just give you these equations. The first equation is the correlation equation. I hope you remember what the correlation is. So the first equation expresses my statement that the correlation between these two credit events, which is the downgrade and the recovery, are negatively correlated. So minus 50% has to be equal to the expression on the right, which is the correlation. Does everybody see that this is the correlation? Okay, I think so. And the other three variables are there because I said that my coins are fair coins. There's a 50% chance of either income, either outcome, not income, other outcome. That's why the sum of those these are all marginal probabilities. They have to be equal to 50%. Okay. The first one, for example, is the probability that my first coin gives me heads. That's 50%. The second one is the probability my first coin gives me tails, is 50%. The third equation is the probability that my second coin gives me heads, which is 50%. There will be a fourth missing, but I don't need it because the fourth one is a linear combination of these three that we have here, which is the probability that my second coin gives me tails. It's going to be 50%, but that is linearly dependent with these first three, so I don't need it, okay? Because the probabilities have to add up to 1. So the last three equations in this system are the ones that just reflect the marginal distributions for my coins. The first one is the correlation. The first one is the important one. So you know what the answer to this system of equation is. You can find it yourselves. It is what you have here. The probability that both coins with a negative correlation, the probability that both coins go simultaneously up or simultaneously down is small, is 12.5%. And the probability they do something different is 37.5%. Okay, all right. Okay, so let me go back to my commercial mortgage solution. And there, what I do is, in the case of independence, it's very easy. I remind you that the expected credit loss is nothing but the multiplication of the expected random variables. So the expected notional, 100 million, the expected probability of default, 20%, and the expected recovery, which is 50%. So it's $10 million. We didn't have a choice because all the four choices I gave you, X was equal to $10 million. But now we know why. It's very, very easy. Let me go to the next one, to the one where we do independence. In independence, we have 4 outcomes. It's a Bernoulli distribution with 4 outcomes. So I have to multiply the $100 million notional, which is fixed, times the first event, which is the expected recovery comes down, which means the loss given default goes up. I remind you, the expected credit loss uses default. Uses loss given default, not recovery. Okay, so it's 60% loss given default times the 30% probability of default, and that will happen with a probability of 37.5%. Next one is also 37.5% when the probability of default has dropped to 10 and the loss given default has also dropped. Okay, these are the most likely events to happen. And then I have the unlikely events, which is that the probability of that the loss given default decreases and the probability of default increases, okay, to 0.4 and 0.3 respectively. And the last one is that the probability of default decreases to 10 and the loss given default increases to 60%. And you have the numbers here. You do the calculation and the answer is 10.5. Now, what is important for this calculation to realize is not the actual number 10.5. What's important is, well, first of all, we can calculate it, but second is, it is indeed true that a commercial mortgage has a bigger credit risk profile than a residential mortgage. A residential mortgage is the one that corresponds to independence. In a residential mortgage, people take care of their homes even if they are going to go default. A home is where you live, you take care of that. Commercial mortgages are known to be more risky. You may remember the events of 2008 when there was the subprime crisis. You may remember that. It was a mortgage-induced credit crisis that we had worldwide. Well, the biggest credit event there was the demise of Lehman Brothers. And Lehman Brothers defaulted because of their commercial mortgage book, not because of their residential mortgage book. Okay, so this thing that we're seeing here is a mock-up. It's very simple mathematically, but it's a reflection of something that happens in reality out there, and that's how the credit market works. Okay, all right. So in the same vein, I'm gonna do this example, then we'll take a break. In the same vein, I'm gonna give you now a caricature of the Goodrich swap, and I'm gonna do it using exactly the same setup that I just gave you. It's a setup I like very much. It's very intuitive and it helps us understand things. So consider the swap between Goodrich and the Morgan Guarantee Trust. As I remind you, the Rabobank leg was not relevant for credit risk. The credit profile is very small. We're not interested in that. It was the leg with Goodrich and the trust that we care about. So I'm going to model it like that. In this case, I'm going to have an exposure which is not constant. It's going to be about 10 million, but it's going to have a standard deviation of 50. In other words, I'm going to simulate it with two values, 15 and $5 million each. And I want to put a default rate, which is going to be on average 10, but it's also going to fluctuate. I want to say 13 and 7. And the recovery is fixed, it's 50%. Here the recovery is going to be fixed. See, what is it that I'm trying to model here? What I'm trying to model here is, mathematically, is the financial reason why this swap existed. I remind you, this swap was considered to be a good deal because we argued that when rates go down, the probability that Goodrich defaults is less because they will sell more, and that increases the notional. And reverse, when rates go higher up, the probability of Goodrich going bankrupt is going to get increased. But at that point, I remind you, the exposure went way down. Okay, so we already argued financially that the credit risk profile of the Goodrich swap was favorable because of that relationship between notional and probability of default. And what we have here is a mathematical expression that does exactly that. Okay, so I'm going to put it in the same context as I did with my commercial mortgage. I'm going to have an expected loss where I just say that the notional and the probability of default are independent, call it X, or one where they are negatively correlated, which we know is the case for Goodrich, and I call it Y. And like before, I can give you different choices. The 4 choices I have here. We can argue, as before, that these ones are impossible because the credit, because the credit risk profile of Y cannot be higher than X. We argued that it has to be lower, so either A or B has to be the case. Now we're going to calculate this, so why am I giving you a multiple choice? I'm giving you a multiple choice because if you are confronted with this and you don't know how to do it, at least by thinking about it, your probability of success jumps from 25% to 50% because C and D are impossible. Okay, that's why I'm showing you this. All right, and it's done in exactly the same way as before. I can do the simulation as, the analytic version as before, which I'm not interested, or the simulation. The simulation is where we understand things. We just reproduce a process with characteristics given, as I did earlier, 2 equally likely future credit states of probabilities of default 13 and 7, and 2 equally likely future exposures given by 15 and 5. We model each of these as a coin, these 2, and the coins will be correlated. We know how to do that, and the answer is for the independence is 500,000, and for the dependence is 460. So in other words, it's lower. Not much lower because of the numbers that I picked, but we just gave mathematical validation to our financial intuition that says that for the case of Goodrich, that swap had a lower credit risk profile because of the specific characteristics of the swap. Okay? All right, I want to now take a little pause, make sure that we're all together, that everything is well understood. Okay, is it? I have more examples coming up. I have now a collection of examples. I'll just go through them, and then when I'm done with those examples, we'll take a break. So let me go. So this is it's a very, very easy example. It's from the FRM, Financial Risk Manager exam of 1998, question 39. It says, calculate the 1 year expected loss of a $100 million portfolio comprising of 10 B-rated issuers. Assume that the 1 year probability of default of each issuer is 6% and the recovery rate for each issuer in the event of default is 40%. That's very easy because we have 10 bonds, and it's asking for the expected loss. So the recovery rate is 40%. It's not 60. This probably is really an English exam. It's not a finance exam. It's very easy. From a financial perspective, the important thing is to notice that the number you have to use is the loss given default, not the recovery rate. So the recovery rate being 60, that means that the loss given default is 40. That means that the expected loss of this bond portfolio is $3.6 million. I'm multiplying the 6% probability of default, the $100 million exposure, and the 60% loss given default, which corresponds to the 40% recovery mentioned in the statement of the problem. Is that clear? Okay, the next problem I'm going to bring to your attention is similar to this, related to this. It's actually the same as this with one difference. First difference is I'm going to get into who the issuers are, whether they are the same or different. But more important, I want to ask you to calculate the unexpected loss. In other words, the standard deviation, not the expected loss. The standard deviation, the unexpected loss is very important for us, is the regulatory capital, remember? So we're going to do that, and I'm going to, well, here's the question I'm giving you. I have a $100 million portfolio consisted of 10 B-rated issuers, 10 million each. Assume the 1 year probability of default of each issuer is 6%. And recovery rate for each issuer in the event of default is 40%, exactly the same as before. Okay, but now I allow for the issuers to be different. So there are 10, and I'm going to, first of all, assume that they're all the same. Second, I'm going to assume that they are independent, perhaps because they are in the same, in different sectors or something. Anyway, mathematically independent. And the last one, assuming that the correlation of default between them is 50%. And I want you to do the calculation of the unexpected loss under these circumstances. You have to do the standard deviation of a portfolio that contains 10 random variables. It's not hard. It's not hard at all. Let me do the first one. I'll do it for you. The first one is when all my bonds are the same. This is a very simple situation. It's the same I had before. The loss distribution is around the variable with only two states, default and solvency, because they are the same. Default loss is 60 million after recovery. No default, loss of 0. The expectation is 3.6. We know that. The variance is then given by this expression. You've seen the variance definition. You know it. I have it here. I have the probability of default, 6%. I have the deviation from default to the expected loss squared. I have the probability of solvency, 94%, and I have the difference between losing nothing and the mean squared. The result is $200 million squared. I take the square root of that, and that gives me the unexpected loss. Okay, is the square root of that, which is $14 million more or less. Is that clear? You know how to do that. This is the simplest example you have done in statistics or probability, the simplest. Okay, so that's in the case that they are the same. What if they are independent? If they are independent, you know that I have a sum of 10 random variables. If I have a sum of 10 random independent variables, okay, then if each of them has a loss of 6 million after recovery, which we saw that, and a no default in the case of no recovery, the expectation of each of them is $360,000, as we saw in the first just a few minutes ago. The standard deviation, as before, is 1.4 million. So the standard deviation of the sum is the square root of 10 times 1.4 million. As you know, when you have independent random variables, the standard deviation grows like the square root of the number of variables. In this case, there are 10. So the answer is 5 million. Okay? And finally, what happens in the case C, when the loss distribution is a sum of 10 random variables, but their correlations are not 0, not 1, they are somewhere in the middle, 50%. In that case, what you do is you just have to expand the product. So you have, this is the data given to you, and to calculate the standard deviation of the whole thing, you just take the variance of that. Okay, so this is the variance of my, these are my loss functions. This is the expectation of the product, right? There, what I do minus the product of the expectations, then I break it down into the diagonal and off-diagonal terms. The diagonals are the sum of the variances. The off-diagonal terms are the product of the standard deviations times the correlation. This is raw, the correlation, 50%. You just do the calculation and you get about $10 million for the unexpected loss. Very simple calculation using what you already know about statistics and probability. Okay? So these three examples give us I think, a pretty good view from the inside as to how credit works and how we can do calculations. There's more problems I have here. I'm just going to go through them. I'm not. You have them on the notes. You can look at them yourself. What I want to do now is I want to get into a credit trade. This is something which I consider to be very revealing for you to understand how credit transactions happen. I'm going to consider a very simple, very academic example, but I think it's going to help us understand how these things work when you're dealing with, you're in the real world with a real portfolio or with a real instrument in a real situation. In this case, I'm going to consider a bond, a very simple bond from a default-prone counterparty. The bond has no principal. It only pays 5 coupons at the end of the second and fourth year. So it's a 4-year bond that only pays $5 at the end of year 2 and $5 at the end of year 4. That's it. And then the bond just matures and is worthless. I'm going to assume that interest rates are 0, so the $5 coupon is if there's no default risk, that would be a $10 bond that you just get the payment after years 2 and 4. But because it's a credit, there's a default-prone counterparty, we will see that the value is actually less than $10. I'm going to assume that my counterparty has a probability of default of 7% per year, and it's the same. It does not change from year to year. I'm going to assume a recovery rate of 0. It's the simplest situation that we can have with two. It's not a 0 coupon bond. That'll be even easier, but not interesting. This one is a little bit more interesting with two coupons. I'm going to assume that the default-free party, the one that actually buys the bond, is regulated. I'm going to assume that it's a bank. And because it's a bank, it's going to have regulatory capital, as we saw earlier. And the regulatory capital in this case is going to be 2 times the standard deviation of losses. Okay? I'll come back to this when we do it, but I'm going to assume that this bond will be bought by a bank that will have a risk capital of equal to 2 standard deviation of losses. I will also show you how that works when the counterparty, the one that buys the bond, the risk-free counterparty is not a regulated entity, for example, a hedge fund. So at some point, I'm giving you a 5-minute warning. Very soon, I'm going to want 2 volunteers, one that will be trading for a bank, then who will be trading for a hedge fund, so we can understand the difference and the competitive nature of a bank versus a hedge fund. That's coming, so get ready. If you want to trade, today's your opportunity. Okay. We're going to assume that the risk capital is updated annually, not daily. Usually these things are done daily. In our example, we're going to assume that it's updated annually. Okay. And on top of that, I'm going to assume that it requires a certain return on risk capital. But I'll tell you what this means later when we actually do the trade. The first thing I want to do is I want to give you some basic mathematical information about the trade that we're doing. What I have here is the default graph. I have the probability of no default of my counterparty right now is 100%. My counterparty is solvent today, but it has a 7% probability of default over the next year. It has a 93% probability of survival of the next year, and it has an 86.49% probability of survival over the first 2 years. And it has a probability of default of 6.5% exactly between years 1 and 2, and so on and so forth. You can all calculate these numbers. They come from a probability tree. Okay? So there's no mystery here. You've seen this many times. I'm going to start with the calculation of expected loss. And I'm going to do it in 2 ways because it's a little bit revealing to do this thing in 2 ways to get exactly the same answer. Okay? In the first method, what I'm going to do is I'm going to calculate the expected cash flows as we did last week. I have a $5 payment in the first 2 years. So I multiply that by the probability of solvency, probability of no default in the first 2 years. And then I have another $5, which I multiply by the probability of no default in the first 4 years. These probabilities I already calculated. They were in my probability tree, so I just multiply, and I get that the expected cash flows is $8.06.5. Okay? So that's the expected cash flows. From here we get that the expected loss is going to be equal to $1.93.5. The difference between $10, the risk-free value of the bond, and the expected cash flows. Okay, so that's the first method. That gives me the expected loss and the expected cash flow. Okay, second method, what it does is it calculates the exposures every year. The first year the exposure is $10 because if I get a default, I lose everything, all the 2 cash flows. After year 2, my exposure drops to $5 because I would have already collected the first coupon payment of $5. And then I can calculate the expected losses as the sum of the exposures per year times the probability of default in that given year, not before nor after. And we can see that the result that I get is exactly the same. It's $1.93.5. Okay? Okay. All right. So these numbers, these mathematical numbers should be clear. Am I right? Yes? Okay. All right. Now, at this point, I would like to get 2 volunteers. We're going to start to do the trade now. I would like someone who's going to work for a hedge fund, one who's going to work for a bond. Do I have 2 volunteers? So, Henry, you want to work for, you get to choose bank or hedge fund. You're still muted. Okay, think about it. Do I have a second trader?
Can you hear me?
Yes, Henry, yes. What do you want to be?
I'll choose the bank then.
Oh, you're a bank. Okay, great. So you're a bank, and Poon Poon, you're here. You're gonna trade. You're gonna be a hedge fund. Yes.
Sure.
Okay, great. So Poon Poon is a hedge fund. Henry is a bank. Now, because Henry is a bank, and so a bank is regulated, and a hedge fund is not. I need someone to work for the same bank as Henry. I need a risk manager. So I need a third person. You're not going to trade. I'm just going to refer you by name because you're going to be the risk manager for Henry. Who wants to be the risk manager for Henry? Kirat. Okay. You are the risk manager for Henry. Great. Perfect. So this is how it works. I'll start with Henry and Poon Poon. How much would you pay for this bond? I haven't done all the math. I'm going to do more math, but I want to start taking positions to try to understand how we think about this and how much we would pay. So I start with Henry. You're working for a bank. How much would you pay for this bond right now without knowing anything else that I'm about to tell you? How much would you pay? Let's do an auction between you and Poon Poon. How much do you pay?
Um, would it be fair to say, okay, so the same bond that we just did, right? Um, would it be fair to say just the expected cash flow?
Okay, that's it. So that's a good way to start. It's a good offer. So you're going to offer
We're
about six,
assuming zero interest, right?
right? What?
Are we assuming zero interest?
Zero interest. Yes, yes, yes. Zero
Okay,
interest. Yes.
then I'll go with the expected
Okay.
cash
So
flow.
you're gonna bid $8. Great. Very good. Poon Poon, how about you?
Uh, I'm not really sure, but that seems fair to me, like the expected cash flow.
Also $8, right? Okay. Well, the sounds good, but let's wait because now I'm gonna do a next calculation. Let's see. This next calculation holds the key to understanding what you can offer. So I'm going to calculate the unexpected losses. I'll remind you the unexpected losses were the standard deviations of my losses. Okay, let me calculate them. I calculate them year by year. This is the formula. It's a standard deviation. Let me not linger on this. Let me just tell you what the answer is. The answer by year is this. The standard deviation on year one is 255. In year two is 246. In year three is 119. So the standard deviation drops. Why? Because you've already received the first coupon payment of $5. And year four is $1.15. So I'm going to use the standard deviation because it's easy in practical situations. You would not use that. You would use a version of the credit value at risk that we saw today. But I'm going to stay with the standard deviation because it's just as good for us. And this is where Kirat shows up. Because what Kirat is going to do is you're the risk manager. And now I remind you something I said at the beginning of the exercise. Kirat, the risk manager, is going to say, Henry, you're going to do this trade. That's great. But remember what you learned in APM 466 about the regulatory capital? And then you say, yes, I remember. So, well, you have to leave some money with the regulator. And then you ask, how much? And then she says, 2 times the standard deviation. All right? Everybody understands that? Everybody understands that? Okay, great. Now, I'll tell you more. Henry. Turns out you don't work for free. You want to get paid, right? And Poon Poon, you don't work for free either. You also want to get paid, right? So when you get paid on what? You can be paid a salary, which will be very easy. But most of the time, your salary, your compensation is linked to how much money you make. Understand that? So what I want to do is I want to tell you that, let's say your bonus, you will probably understand this. Imagine I tell you that your bonus is 10% of your gains, right? All right. And that's true for both of you. But I'll focus on Henry because Poon Poon has no risk manager that says that you have to send money to the regulator. But Henry, you do. So Kirat is going to send $5. It's going to take $5 from your P&L and you're going to send them to the regulator. What's your cost if she takes $5 from you? Your cost is 50 cents. Your cost is 50 cents. Interest rates are zero, but your cost of capital, your opportunity cost is 10% because this is how much the money costs you, right? Think because you have a certain, you get paid on your P&L. So if you have less money to trade, that will hurt your P&L. So this is a different consideration now. Okay, so let's take that into account. Let's go to the next calculation. Okay, so let me now calculate the credit reserves that I have. So in this case, Akira told you you're going to have 2 standard deviations for that. That means in year 0, you have to send $5 to the central bank. In year 1, at the beginning of year 1, you have to send only $4.93, a little bit less because 1 year has gone by. Then in year 2, between 2 and 3, you have to pay less because you've already received the $5 first coupon payment. So you sell only $2.38. And the last one is $2.31. So let me say, and you will understand this, let me say that your cost of capital, the actual cost of this money that you don't have for you is about 10%. You understand where the 10% comes from? This money, this $5, is money that you no longer have to trade something else. So it's going to hurt your ability. Sorry, not hurt. It's going to diminish your ability to make profits. The way this thing is handled in the bank is you're typically given a cost of capital. If you're a trader at the bank and your boss says, here you go, you have a $100 million portfolio for you to trade. There's typically a cost of capital. Here I'm assuming 10% is very high, something like 5, which means that if you make 5, you don't make any money. Your bonus starts at 5. You understand? So we're going to model that by saying that your cost of capital is 10%. And that's the same, by the way, for you as well as for Pum Pum, because this is the cost of money. The money is not free. You may think I have $100 million a balance on my trading portfolio, but that money is not given to you for free. You don't have to pay, but there's a cost, and the cost is typically subtracted from your bonus. So both of you have that cost. But the difference is that Pum Pum has to send nothing to the central bank, but you do, Henry. So let me now go back to the question I asked earlier. How much would you be willing to pay for this bond? See, at this point in time, with an annual cost of 10%, you have an additional cost, Henry, of $1.47.
So before, if I said I wanted to pay the expected cash flow, so now I would have to subtract that additional cost in order to sort of break even, right?
Exactly. So what you're going to pay, I don't have the number here, I thought I did. What you're going to pay is you are going to pay about $6.50. That's all you can pay. At $6.50, more or less, you break even. But Pum Pum, how much can you pay?
I don't have to pay to the central bank, right?
Right. You're a
So
hedge fund.
Should it just be the same?
So here's what you can do. Now this is very interesting, because in practice, Pum Pum, maybe you have been at the same bank where Henry is before. Maybe you even know Kirat. She was your risk manager too. So you've been in Henry's shoes before. You know how much Henry can pay. Right? Imagine that it's just the two of you. How much would you pay?
Well, probably not more than Henry does for no reason.
Well, the thing is, let's do, I mean, I don't have the precise calculation here, but let's say that Henry, his limit is $6.50. How much would you pay?
Like $6.51 or something.
There you
like
go.
that.
Exactly. That's what you would do. $6.51. And Henry, at $6.51, you cannot compete. And now, Pum Pum, you make a lot of money because your expected cost. Sure, you have a certain risk, and we should calculate that. Okay, but at least the expected gain in your portfolio is $1.50, which in a $10 bond is a 15%. That's pretty good. You understand how the world works now? This is, by the way, let me ask you a question. The question to all of you. Now, you understand the important role that Kirat plays here, the risk manager. We went through this 2 weeks ago, but now it suddenly became live. I explained this to you when we went through risk management two weeks ago, but now it's live. And we see that Kirat, in demanding that Henry has $1.47, is decreasing the competitiveness of the bank, right? There's nothing we can do. This is what it is. But what if you find a way to make that number less? What if Kirat is figures out that there is an offsetting risk somewhere else in the bank, and because of that, risk is not linear. So the fact that this bond gives an increased risk profile of $1.47, maybe not. Maybe this is the internal risk of that. Maybe there's other risks in the inside the bank that offset these ones. And Kirat will be the one to know, right? And now maybe you worked there before, Pum Pum. Maybe you know Kirat and everything, but you don't know. You no longer know the other positions the bank has. So you don't know if there's offsetting risks. So now you start to hesitate. Maybe you're not so sure that $6.51 will give you the bond. Maybe Henry, because of something else that he has done, his regulatory capital has dropped, and then he can offer $7. So he takes the bond and you lose it. So this is a risk-induced trade. All of the considerations we're doing here have to do with the regulatory capital. Regulatory capital is very important. Banks have it, insurance companies have it, hedge funds don't have it. And it affects the price you pay for transactions. This is new. We haven't seen this before, but this is a consequence of what has changed. What has changed is that reading week after reading week, no one works for free. And not only that, certain entities are regulated and they have regulatory capital. Okay? See that? Okay, now this is a very important point. And this example is good in the sense that it explains what's going on in a very, very simplistic setting. When you go out there and you get a job, and you will see that things are incredibly complicated. But I give you some advice, which is don't forget this example. This example gives you lots of clarity when you're dealing with a real transaction, very complicated, with a real risk calculation, very complicated, and in a competitive environment when you're competing with other entities who may be regulated or not. Okay. Okay. So I think so. This is a good. I hope this is clear. I hope you learned this. It's I think you understand. This is it's a very nice example. Okay. What I'm going to do next is, it's too early for a break. I'm going to do the credit matrix model, and then we'll take a short break, and then I'll give you the Merton model. The credit matrix model is one that goes at the heart on how to calculate the unexpected loss. We just went through that. We see how important it is. Kirat was in charge of that. And I said, I take 2 standard deviations. Thank you very much. And that's what you do. But in practice, you don't do that. You don't take 2 standard deviations of something as simple as that. Or you may take 2 standard deviations, but it's a very complicated portfolio. How do you do that? That's what I'm going to show you. That's what I'm going to show you now. I'm going to show you how we can model credit reserves and credit losses, but especially credit reserves in a commercial way when we're dealing with very complicated transactions. Okay, so now this goes into the calculation. We're no longer doing 2 standard deviations. We're doing other things now. Okay, so this is a commercial model. I remind you, this was conceived by JP Morgan in 1997, 1 year before the big credit event of the 20th century, which was the default of London Capital Management. So they came up with this. And how does this work? Well, this works as follows. Credit risk is driven by movements in bond ratings. So it is risk neutral in the same sense as we developed here last week. I look at your rating for the bonds, and if your rating gets worse and I have a transaction with you, then I lose money because then my transaction is worse. So I look at the ratings for that. We already saw that the ratings imply a probability of default. We saw that last week. And that's going to be implicit in all the calculations we're going to do now. And we have a transition probability matrix for migration probabilities, just like we described last week. Okay, so this is the Markov model we developed last week. That's how credit matrix starts. That's how it starts. That's not how it ends, but that's how it starts. Each instrument is valued using the credit spread for each rating class. Okay. And I'm not going to focus on recovery rates in this explanation. They are taken into account, but let me please ignore that in my explanation to you as to what credit matrix is. I will have to explain to you how correlations are done because it's one of the weirdest things I have ever seen. I'll explain to you. It's almost out of necessity because this is very difficult to do. Credit correlations are very hard to do. I'll explain them to you a little bit, but I'll tell you how they are doing. And something very important is that it does not integrate market and credit risk. It considers market and credit to be different. Okay. In particular, it only assumes that the spread curve will change, not the yield curve will change. But that's not so important. So here's an example. Imagine I have a triple B rated bond, could be Goodrich. And I see that the probability of default, this is all coming from the transition probability matrix. I remind you, we saw this last week. So credit matrix comes equipped with a transition probability matrix, and there I can read the transition probabilities to the other states. I can see that it's a 2%, there's a 0.02% chance of an upgrade to a AAA. I see that is an 86, almost 87% chance that it stays the same, triple B, and so on and so forth. And I also give you the value. If it gets upgraded, the value will be higher, and if it gets downgraded, the value will be lower. All of this is given to us either by the transition probability matrix of the Markov chain or by market prices. So it is something we can observe. All right, so from there I can do statistics. I can calculate the expected value, and I calculate the standard deviation, just as we have done in the past. Okay, great. So here what I have is I'm going to consider the different loss events. I have a probability of loss of $56, which is the difference between 107 and 51, and that will happen with a probability of 18%. I have a loss event of $23.91, which is this one here, with a probability of 30%. Okay, I have to look at the cumulative. Okay, and I have a loss event where I can lose $9, and that's a cumulative probability of $1.47. That's those three added together. Then $5, 6%, and so on and so forth. That's the curve that gives me the cumulative distribution function for my losses for the different events that might happen. Okay? And there I can see that the worst credit loss is the 95 percentile, which if I interpolate is about $10, right? And I can see that the worst credit loss with 99% chance is bigger than that, is $20. All of this comes from this curve, because the worst credit loss is the 95% quantile, and the worst credit loss is the 95% worst credit loss is the 95% loss quantile, and the 99% worst credit loss is the 99% quantile. Okay, so I go to the number 5 right there. I don't know if this is clear. I'm going to make a note here. So that's 5, and that's 1%. Okay? So that's how I get my worst credit loss, minus 10, minus 20. Okay. So that is how I can get my worst credit loss, my credit value at risk, and all of that, my expected loss, all of that, when I have a single counterparty. What happens if I have several counterparties? If I have several counterparties, then I'm going to, I need the correlations. At the very least, I need the correlations. We saw a few weeks ago that if I have copulas, I can do better. Creditmetrics does correlations, and that's what I'm going to explain to you. I'm not going to do copulas. And the way correlations are done, I'm going to explain them to you with an example. It's just a recipe. There is no mathematical foundation for this. It's just a recipe. And I want to explain the recipe with a specific case. I want to take two counterparties, DuPont and Allianz. DuPont is a plastics manufacturer in the United States. Allianz is an insurance company in Germany. How would I calculate the default probability, the default correlation between DuPont and Allianz? How would I do that? This is how it's done. So it's a recipe. It's a little bit like the cooking recipe. You just mix the ingredients and don't ask, just do it. Okay? There's no real, if you want to know why these things happen, there's no real good answer. So the basis for that is some data which is given to you by the Creditmetrics company. It in addition to the Markov chain with the transition probability matrix, we're also given other information. We're given country indices, which includes specific companies and specific countries. And we're going to give us, and it also gives us worldwide indices. So I look through the database, and I'm supposed to do a linear regression. I'm supposed to regress, and listen to this is very weird. I have to regress the values of equity of DuPont and Allianz, the values of their stocks. I have to do a linear regression between that and all of the indices given to me. That's a monster exercise, and it's very bad. But anyway, I just follow the recipe. I don't ask. And when I do that, what I see is that after I do the regression, I get this result. This is a result that kind of makes sense, right? Because DuPont is the plastics manufacturer, so it's related to the US Chemical Index. And this is not an index that you get out of Google, Yahoo, or Bloomberg. No, this is given to you by Creditmetrics. It has a beta of 90% and an error term. Okay? That is the number for DuPont. For Allianz, what I see is that it has a beta of 74% with the German insurance index, not surprised by that, and a 15% beta to the German banking index, not surprised by that, because at the time this calculation was done, they owned Dresdner Bank, which is a German bank. They don't own it anymore, but back then it was. So this is not surprising. So I can do that. You can all do linear regression, so that's checked. That's easy to do. And the key is the information which we have at our disposal given to us by Creditmetrics. Okay, it's a commercial model, it's not a mathematical model, and certainly not an academic model. Okay, so what you're asked to do when you have that is you have to do the following calculation. And listen to this, because this is hard to, easy to misunderstand. I stipulate, I declare that the default correlation between these two counterparties, DuPont and Allianz, is given by the following. Look, what is this? This is the products of the betas times this element here, which is given to me in the database, is a default correlation between two indices. Now, indices do not default, so it is not like the default correlation between the indices. It's just that it's the number that appears in the formula. You just have to plug in that number there from the one that's given to you in the database. You understand what I'm saying? It's a bit of a voodoo, but that's what you're supposed to do. And here, what you do is you multiply the betas, same thing, after multiplying by that index correlation number which is given to us in the database. So these are numbers which are sold to you. They are not calculated, they are not mathematical numbers, they are just numbers in the database. And that's how you calculate the default correlation between the counterparties. Is that more or less clear? With all of the mystery surrounding these definitions. Is that clear? It's a recipe, you just follow it. Someone implements that in Python and you're done. Okay? Okay, so once you have that, what do we have now? What we have, I remind you, let's do an inventory of what we've learned. What we've learned is, we know for one counterparty, all of the instruments we have there, we just value under all the different credit situations from a counterparty, and I can do my probabilistic assessment. As we saw earlier, I can do I have my cumulative distribution function, I can do my quantiles, I can do my credit value at risk, all of that, for one counterparty. And for many counterparties, I can do the correlations. So what I do now is I put it all together. I put it all together because now what I have is, if I have 1,000 counterparties, what my instrument is with all counterparties, I just lump them all together. The thing is that my counterparty can have 8 possible credit states next year. I just put all of my portfolio positions there. My portfolio value is linear. So for a counterparty, what I have is 8 possible states for next year. Okay? So I call it M, but let's say 1,000 counterparties and a total of 8 possible credit states in the future. So what I do is this. I need to simulate 8 to the power 1,000 possible states, because I have 1,000 counterparties, each of which can be in 8 possible credit states. Okay? I need to do a simulation of 8 to the power 1,000. Do you know how big that number is? It's pretty big, isn't it? Let me ignore that. Okay? That's why they pay some people the big dollars to do this calculation. Let me now. This is the mathematical part of the argument. It's the only thing which is mathematical in the credit matrix calculation. So I'll just stay mathematical. I will not get into the implementation horrendous difficulties that this has. Okay? So I have to do 8 to the power 1,000 simulation. That's what I need to do. But the simulation, at least mathematically, the simulation is something that is something we can understand, because the marginal distributions is what we calculated on each of the counterparty distributions that we did earlier. We did it. And we put them all together using correlations, which we obtained through the regression recipe, not model, regression recipe. So this gives me a massive Monte Carlo framework, but at least it's doable. It's just something that I can do. If I had an infinitely fast computer, I would be able to do it. Understand? That's how Creditmetrics works. And from here, I can calculate same thing as before, my expected losses, my unexpected losses, credit VAR, worst credit loss, all of those things, and all of the regulatory parameters that the regulator and here at our risk manager will need to value portfolios. Okay? Good? Great. Okay, so we have climbed our second hill. The hill that's left is the last one, perhaps the steepest one, perhaps also the most beautiful one for today, is the Merton model. So what I'm going to suggest is we take a break now, come back in 10 minutes, maybe you have time for a coffee. I highly recommend it. Highly recommend it. And in 10 minutes, I'll tell you the Merton model and how everything we have done today and last week can be redone in one fell swoop. It's just something beautiful. It's coming. 10 minutes. I'm going to now tell you a completely different approach to credit risk, which starts from even the point of origin of this is very unique. It's very different from what we have seen. This is a theory that goes back to 1974, and Robert Merton did it. I remind you something about history. The Black-Scholes equation is from 1973, done by Fisher-Black and Myron-Scholes, and their work was published with the help of Robert Merton, who was working on the same problem. And we saw the Black-Scholes theory a while ago. Now, it turns out that one of the reasons that Robert Merton, one of his motivations to do what we now call the Black-Scholes theory, although some people call it the Black-Scholes-Merton theory, is that he wanted to understand credit from the following perspective. Let me give you some basic fact about corporate finance. When I have a company, the company has two things in its balance sheet. It has assets and liabilities. Assets is what the company a company has in its balance sheet has assets and liabilities. The assets is what you have, and the liability is what you owe. Companies have a limited liability characteristic, which is that if you owe more than what you have, you can always close the company and go away. That means that a company, the stock of a company, is really a call option, where the underlying is the value of the company, the value of the assets, and the strike price is the value of the liabilities. You understand? The value of the company is the excess between the assets and the liabilities. But if the assets are less than the liabilities, the value is not negative, it's zero, because you can always bankrupt the company. That is a very interesting perspective because it shows that equity, what we call equity, is really a call option on the assets of the firm. Now let's take that beyond that observation, because what happens when there is default? When there is default, meaning the value of the assets is less than the value of the liabilities, what's the recovery rate? The recovery rate is the value of the assets. Okay, so in other words, from this perspective, the value of a debt of a company is the value of the debt itself, the liabilities when they are above the assets, or the assets when they are below the assets. And the value of the equity is the value of the assets minus the liabilities when they are higher, or zero when they're lower. In other words, what Merton had developed is an option definition of the credit characteristics we've been studying for 2 weeks. Let's see what that looks like, okay? So from his perspective, default occurs when the value of the debt is higher than the value of the assets, as I discussed, and equity is an option on the assets of the firm, a call option. So from that perspective, also we just take this, let's just take this notion a little bit further. The value of the firm is the maximum value is the maximum of the assets minus the liabilities, as we have here, and zero. And the value of the debt is the minimum of the value of the liabilities and the assets. In other words, if the assets are below the liabilities, we have default, and then the asset is your recovery rate. Okay? That's Merton. This is what Merton was doing. And in this theory, we're going to denote VT, the value of the assets. The stock price, as you can see here, is a call option, and the bond price is some sort of a put option on the value of the debt. Okay? That's very revolutionary, and it's a very interesting way to think about credit. So what I'm going to do for the next, say, 20 minutes or so is use the Black-Scholes theory that we developed weeks ago to, well, I want to bring it in the context of, credit and see what that does to credit. I'm no longer going to be discounting cash flows as we did last week. I'm not going to consider the default process or anything like that. Everything we have built is going to come from the Black-Scholes theory. Everything. So I'm going to assume now that assets follow a geometric Brownian motion with its drift and its volatility term, as we have seen earlier. We saw that for stocks, but now we're not using this for stocks. We're using this for assets, the value of the assets. And I remind you, stocks are the option on the assets. Okay, so this is, we're turning everything upside down. The Black-Scholes theory had some formulas in it, which I'm now going to use out of convenience. And these formulas will tell me that the stock is going to be equal to the Black-Scholes price of the option with the underlying V and the debt given by K discounted to today's value with R e to the minus RT. And these are some of the elements that appear in the Black-Scholes theory. I just refer you back to when we saw that. It's not important for us right now. I will have to use the interpretation of what these numbers mean, but I'll give you the interpretation when we need them. For now, let me just say that these are formulas that we have seen before, and we're in control of this. Okay. Now, I have to mention one very important comment. The only difficulty in carrying out this analysis that I told you here is the fact that we know everything to carry out our model except for one thing. We don't know the asset volatility. Remember, the underlying is the asset. It's not the equity. The equity, we know the volatility. You can look it up on the markets, okay? Either by looking at historical values or even maybe traded values, the implied value from Black-Scholes. But the asset volatility we don't have. And asset values are calculated probably once a year. We don't have enough information to calculate the volatility because we don't have a real time series for the value of the assets. We may have a few observations, but not enough to get them. So this is an obstruction. The way around it is by making the following observation. And the observation is that the evolution, I'm going to use Ito's formula. By Ito's formula, since the stock is a function, is a price of the assets, therefore it's a function of the assets, I can apply Ito's formula and I can see that the stochastic term of the of the Ito process defining the stocks is related to the stochastic part of the assets defining the value, the geometric Brownian motion. And the proportionality constant is the hedge ratio, is the delta of the option. Okay? So in other words, I can take that expression, which comes from Ito's formula, and I can rewrite it by deriving this expression that we have here. The volatility of the stock times the stock has to be equal to the volatility of the assets times the assets times the delta of the option. Okay, let's look at this equation and with great care. It may seem that I can take this equation and I can just work out the volatility of the assets and write it as an expression that involves the volatility of the stock, which I know, the value of the stock, which I know, the value of the assets, which I know, and the value of the delta, which I know. But note that I know the value of the stock, I know the value of the delta only if I know the value of the volatility, because they are a function of the volatility. And the volatility is what I'm trying to find. Okay, so in other words, what I have here, it may seem like an expression for the volatility of the assets, but it's not, because the volatility of the assets is here too. It's the independent variable of the right-hand side. So what we have here is a fixed point. This is a fixed point. Fixed point, okay? I'm assuming you have seen a fixed point. A fixed point is if you have a function from a certain space to itself, a fixed point is one which is kept constant by the function f. That's a fixed point. And this is a fixed point because this right-hand side as a function of sigma should give me sigma. Okay, now you may also have seen a way to find fixed point. Mathematics is full of fixed point theorems. And there's one that's going to be very relevant for us to calculate the value of the volatility. I will do that a little bit later, okay? In fact, the way to do that is as follows. I'm going to show you how this is done in a real case. I'm going to go back to Goodrich, and what I did here is I recalculated the volatility of the assets of the Goodrich deal. I could not go back to 1982. The data that the Securities and Exchange Commission publishes about companies, which I needed, is only goes back to 2001. Before that, the SEC was not digitized. So this data, you may have to go in person to get it. I may have to go to Washington to get that data. But if I go back to the data that I could obtain from the Securities and Exchange Commission database, this is the situation. I have the, obviously the interest rate, I say is 3%. Back then it was 11%, but I don't have the data. That's all I can get, okay? So this is not important. This is not realistic, but it's not important. I just want to show you how we can use the example I just showed you earlier to calculate the asset volatility. By the way, this is something that you will have to do in your assignment number 2. Exactly the same thing I'm doing now, okay? So let's make sure that you understand. The book value of the assets is something that is reflected in the financial statements. You just read it of the financial statements, or you ask ChatGPT. ChatGPT will give it to you. In the case of Goodrich, it's 7.7 billion. The book value of the liabilities, you also can ask ChatGPT. It's also in the financial statements of the company, and these are public, is 4.1 billion. Okay, you understand what I'm saying, right? This is accounting information. This is the number of shares outstanding, 102 million. And by looking at the stock exchange, and you can also probably ask ChatGPT to do this for you when you're doing this thing for your company. I don't think you can ask ChatGPT to calculate the volatility of the assets. Maybe it can, maybe it can. I don't think it can. You may have to do all of this, but you can use ChatGPT to help you get all this fundamental information. So from the New York Stock Exchange, you can see that the stock volatility was 50%, which we need, and the share price was 32. Again, I'm picking a particular point in time. And now I do this calculation. I calculate the book value of the equity. The book value of the equity is the value of the assets minus the book value of the liabilities, is 3.6 billion. Okay? Accounting. This is very simple accounting. If I project this to the future with a 3% interest rate, I can see that the future value of the debt is going to be just over $4 billion, 4.12. So these are numbers that I'm going to need to apply my Black-Scholes theory to calculate probability of default and other things. When I look at the market value, I can see that the market value of the stock is $3.2 billion. And notice the discrepancy. The book value in this case is higher than the market value. Do you know why? What happens, or why is it possible that the book value is less than the market value? Normally the market value is several orders of magnitude bigger than the book value. Why is that? That's because investors were not fond of this company and they're running away. So the company value was depressed. This is unusual, okay? Happens for companies in distress. So with that information that we just calculated, what I'm going to do is I'm going to follow the fixed point theorem that some of you may know from mathematics, but I'm going to show it to you here from almost from a programming perspective. So what I'm going to do is I'm going to keep track of all of the variables that matter, all of the variables that enter the Black-Scholes calculation for the value of the equity. So I have an interest rate, 3%, that doesn't change, it's constant. I have an underlying price for the equity, call it V, for the assets, sorry, underlying price is the assets, V. The time to maturity, I call it T, but it's a year. The exercise price, that's the value of the debt, which we calculated earlier, is in the financial statements. ChatGPT will give it to you. The stock volatility, which I know, it's about 50%. I can calculate it from the market. And then the asset volatility. The asset volatility is the unknown, is the one number I don't know. So think of this as a spreadsheet where that cell is unknown to me. I don't know what it is. But I know it has to equal the last cell I have in that column. It has to equal sigma S times the value of the equity divided by the value of the assets and the delta of the option. I know that. That's the expression that we obtained earlier. And then, of course, with that, I have the option price and the delta, both of which are calculated using the option price or the Black-Scholes framework. Okay? So that's the set of parameters I have and I iterate. Now, in my first iteration, what I do is I use, I have to iterate, I need to calculate the, I need to calculate this expression here using the value of the assets, which I don't know. So I make a guess, and I put here the value of the stock. It's wrong, but this is how, for those of you who have not seen this, the way you run many of these fixed point theories is that you just iterate. When you iterate, this converges to X. That's how you find, or in other words, you create a sequence which is this one. It's just an iteration. And under certain conditions, that F is a contraction, this will take you to a fixed point, okay? Some of you may have seen this, but I'm telling you, this is one of the traditional ways of finding a fixed point. And that's the one I'm using here. And as you will see, it's one that works extremely well in this example. It should work well also in your example when you do assignment number 2. So I pick one. This is wrong. Doesn't matter. It's the number I have. But it allows me to calculate using the Black-Scholes formalism. It allows me to calculate the option price, the delta, and the fixed point. objective. So I have that, and from there I can see is that I have a new candidate value for the asset volatility, which is no longer 50%, it's now 26.47. Why? Well, I got that from the expression that defines my fixed point iteration. So I take that, now I can run my Black-Scholes equation again, and I can get a value for the volatility and a value for the delta and a value for the option price. See that? That's the Black-Scholes calculator. So I iterate again, and guess what happens? I get that the asset volatility calculated as the Black-Scholes price repeats itself, is 24.2 again. What does that mean? That means that I managed to find the asset volatility. It's equal to 24.2. Okay, there you go. At this point, we stop. We know we have found the asset volatility. Is that clear? I want you to understand this. On YouTube, I have, I think last year I singled out this particular explanation as an independent video, and I'm happy to do it again if you just want to go through this. This is one of the important points of today. We have seen a number of important points today. This is one, okay? Because you'll have to do this for assignment number 2. So you may want to go through this. Now, I have a comment here, which is that I'm going to try to answer a very interesting question, which is, what is the value of the limited liability provision? Companies don't need to get into negative valuation. They can always go bankrupt and not have to pay. So what's the value of that? What's the value of the limited liability provision? Let me show you how we can calculate that. In this particular case, I can see that the market value is 3.2 billion. The book value of the equity minus the future liability is 3.6, and the option value, which defines the value of the equity, is 3.72. So, sorry about that. So, there you go, 3.72. So the difference between the book value and the option value is the value of the limited liability. So in this case, the value of the limited liability is about $122 million. We can value that too. Okay? All right. Okay, so this is my comments about the fixed point. That's how we calculate it. We saw that. And now let me use all of this to price the debt of a company. When I price the debt of the company, the debt is the value of the assets minus the value of the equity. So I'm using the Black-Scholes formula for the value of the equity, and I just bring it down here. That's the value I have. Okay, these are all of the elements from the Black-Scholes price. I'll identify them for you because a miracle is about to happen on the screen. Okay, this is the miracle. This is a miracle. I'll explain to you why this is a miracle. Because what do we have here in this expression? You see, this expression is the same as the previous expression, where I have divided the value of the debt, B, by the risk-free value of the debt, which is K discounted to today's value. Okay? K is the future of the value of the future liabilities. Discounted to today's value is K times e to the minus RT. Okay, so what I have here is I have an expression which is a Black-Scholes term, which is the probability of exercising the call. In other words, is the probability of solvency. This N of D2 is the probability of solvency. I would like to remind you that we saw an expression last week that told us that in our very simple one state Markov chain model, actually two-state Markov chain model, we saw that the hazard rate or the credit spread, the spread was similar to the probability of solvency. Okay? Actually, to be exact, it was proportional to the exponential. So the exponent was proportional to the logarithm. Well, the exponential of, actually, the formula we saw was the exponential of h was proportional to the but this is 1 minus h was proportional to that. But by Taylor's expansion, what get is this expression here. So, okay. So what we saw last week was that the exponential of the credit spread was proportional to the probability of solvency. We saw that last week, I remind you. But that's what we have here. This is the Black-Scholes probability of solvency, probability of no default. And what is this? This is a bond with the spread, and this is a bond without the spread. When you divide by one by the other, that's what you have. So I want you to notice that what we have here is the same expression we saw last week. See that? This is remarkable. This is the expression we saw last week. And now you may ask, how about this? What's that? Well, let me tell you what this is. Let me tell you what this is, because the expression we obtained last week, this one, this was assuming there was zero recovery. You saw that when we had recovery, the expression was a bit more complicated. Well, this is the recovery rate. And I remind you that the Merton model has recovery built into it. So if it has recovery built into it, everything we saw last week and even everything we saw today will resurface, but knowing that the recovery rate is no longer constant. It is stochastic, but it's of the same type of stochasticity as everything else. And that's why it's all built into the same model. Okay? So this is a deep observation. It's really a miracle. So that's the first thing I wanted to mention to you. First thing I wanted to notice. I want to now talk about credit loss, where another miracle is about to happen. I have a very long expression here for expected credit loss. Trust me, this is what comes from the Black-Scholes formula. And here again, we see another miracle, because this is something similar to what we saw earlier today when we followed an approach to credit which is completely different from what we're seeing now. This Black-Scholes term is the probability of not exercising the call, which is the probability of default. What I have here is the present value of the bond. In other words, is the exposure. And once again, what I have there is the adjustment I need for the stochastic recovery. So I have recovered again another formula we saw earlier, and the path I took is completely different. I did everything within the context of the Black-Scholes theory. You understand what I'm saying? That's another miracle. Okay. Now, this model we have seen is very nice, but it's a bit complicated. There's a simpler version of it, which was the commercial version of the Merton model that was done by Vasicek, McEwen, and forgot what it stands for. Okay, these two people. So their perspective is this. When I look at my firm, the firm has a certain value today, V naught, and it has a certain evolution of those assets in the future. The result is some log normal distribution. We're going to approximate the log normal distribution by a normal distribution. That's the first approximation we're going to do. And when we do that, I only have to look at the value of the liabilities, which is what they call the default point. And then very simply, I will have solvency when the value of the assets is above it, and I will have default when the value of the assets is below it. But because this is a Gaussian, I know the cumulative distribution function of the Gaussian very easily. So what the KMV model does is it redesigns everything we have seen for the Merton model in an even simpler, well, not even simpler. The Merton model is not simple. The premise is simple, but the development is complicated. They simplify that to a Gaussian model, and then they draw the conclusions directly from the Gaussian model. For example, I have an example here. You're asked to calculate the probability of default of a certain firm when you are given the value of the assets, the value of the liabilities, and the value of the volatility of the assets. And what you do is you apply the Gaussian model we just saw. You take the assets minus the liabilities, 200 million, divide by the value of the volatility, which is 100 million. That's the volatility. And then you use the cumulative distribution function of the Gaussian to get what the answer is. Okay? That's how you do it. The answer is 2.3%. You understand what I'm saying here? I need you to understand this example because your assignment number 2 needs to do something like this. Is that clear? Look at it. Make sure you understand it. A, assets. K, liabilities. Sigma, volatility in dollars. Not percentages, dollars. Result, 2. So the probability of default is 2.3. I'm using a Gaussian model. I use the Gaussian cumulative distribution function. That clear? Okay. You have to do this in your assignment. I asked you to calculate the cumulative distribution. Sorry, I asked you to calculate the default probability using Creditmetrics, which we saw, and using the Merton model, which I'm showing you now. But this is the version of the Merton model you need to use. It's very, very simple. And by the way, I asked you to do it over time. Can you do this over time? Yes, of course you can do it over time. Everything scales over time in a very simple way. Okay. Because they're all Gaussians. You know what the evolution of the Gaussians is going to be. The Gaussian grows like the square root of t. So you pull that into the model and you're going to get a time-dependent expression for the probability of default of the company you choose. Okay? Okay. I'm assuming that you understand something. I'm assuming what I recommend to you now is that you attempt to do this part of the assignment in the next week or 2. As I told you, don't write it down until after my last class, but you can start to gather the information and you can do these calculations now. Once you understand what you're doing, the calculation will not be very hard. Be careful if you use a large language model to do this, except to give you the basic information, because the large language model will probably not know what to do, and they will do whatever. That's my experience. But I would use a large language model to get me the accounting information of the company you pick. You pick TD Bank, then ask, what's the asset value of TD Bank today? What's the liability, or not today? So in the previous audited statements, or in the previous statements, what's the value of the debt? Get that information. Then you build that into the model. You can even use the large language model to calculate the option price for you. That's okay. But the logic, I doubt the large language model is going to be able to follow. There's not enough information out there for them to be trained the right way to do this. But then you will do it, and you will be in command, and you will be able to calculate this way, as well as using the Creditmetrics model. But I remind you, you're going to use the two-state model, the one we did last week, the easy one, where a company is either in default or not, and you can calibrate the probability of default from a single bond, bootstrapped, and compared to the risk-free yield curve. Okay? So you have to do and then you have to compare, and that's where your assignment gets interesting, when you start to do the comparison, because you're going to get very different numbers if you use the Merton model or the other one. And I want you to explain why you get the difference, and that's going to be, and then suddenly you have too much information. How do you put all this information into that? And that's where the last lecture of this course will come in handy, when I tell you how to present information. Okay?